Dear ICCS members and friends, good afternoon and welcome to this webinar session organized in partnership with ICCS members Dentons, Rodaic and Davidson. My name is Carola Capone and I'm the Marketing Executive at ICCS. Welcome to everyone once again. Today's webinar session will be focusing on global implication on the global tax minimum rate. And in particular, it will be focusing on the impact on the Singapore's tax regime and economy. Without any further ado, I would like to introduce today's speaker, which is Mr. Edmund Liao, Senior Partner at Dentons Rodaic. But before giving him the floor, I would like to give the word to ICCS President Alberto Martinelli for his welcome speech. Thank you, Alberto.
Thank you, Carola. Dear members, friends, and partners of the Italian Chamber of Commerce in Singapore, ICCS, on behalf of the board, welcome to today's seminar organized in collaboration with Dentons, Rodaic, and Davidson. As a background myself, in my professional life, I'm very eager to learn from our distinguished speaker, Edmund Liao, Senior Partner of Dentons, Rodaic, and Davidson, about today's topic. Offshore finance is a global huge business that attracts roughly 10 trillion US dollar. In a quite difficult ranking to find, offshore booking center sees Switzerland leading with roughly 2.3 trillion US dollar, followed by the UK and its islands with roughly 1.8 USD trillions. Then the USA with 1.5 trillion. It is a little bit surprised given that the US don't even participate to the CRS, the Common Reporting Standard, the automatic exchange of information. Then we have the Asian booking centers with Hong Kong, 1.1 trillion. We all know the challenges that Hong Kong is facing, and Singapore, shy 1 trillion. The rest being spread across Middle East, Central America, Caribbeans, and of course, some of the European Union countries, such as Ireland, Luxembourg, Belgium, and the Netherlands. Offshore finance provide a huge business to its booking centers. Like just take Singapore as an example. The overall Singapore banking and insurance sectors provide roughly 13.3% of GDP, of the gross domestic product in Singapore. It's a business of 49 billion US dollar, and it employs roughly 170,000 people. We should also take into consideration that offshore finance provide cheap financing to fuel the banking system of such offshore centers. In fact, Switzerland, Hong Kong, and Singapore, they manage roughly each 3 times more of their own GDP. Huge. Of course, all these assets are legally and tax compliant managed. They are offshore for tax shielding, tax legal shielding reason, or opportunistic reasons. After 2008 financial crisis and the draconian government spending initiatives to keep the financial global system alive and to support the major economies, and lately the COVID pandemic crisis, this business model has been scrutinized, looking for some realignment. It is estimated that just taking into consideration the 500 largest US company, they keep almost 2.1 trillion assets abroad, shielding roughly 600 billion US dollar of taxes. Among them, we have Pfizer, General Electric, Apple, Microsoft, FedEx, GE, Nike, very reputable companies, and they do all that in a tax compliant way. If we take the EU countries, we have a similar trend. In fact, just across the EU itself, across its borders, we have 81 free tax zones. And if we take in consideration how many multinational government tax rulings that have been closing countries like Ireland, Belgium, Netherlands, and Luxembourg over the past 5 years, this has been skyrocketing with 160% more new agreement, new tax ruling compared to 5 years ago. At the recent June G7 countries meeting, the G7 comprehends of Canada, France, Germany, Italy, Japan, UK, and the USA. It was reached an historic global agreement by which it will be set to 15% a global minimum tax corporate rate. Now, the US Secretary, Treasury Secretary Yellen, former also chair of the Fed, has been calling it the end of a 30 years long race to lower corporate tax rate in order to attract multinationals. Well, it was well perceived by the financial centers and by the company itself, which will be affected by these tax rate changes. In fact, if you look, the market didn't tumble. If you look closely, you will see that precisely around the announcement of these global tax rates initiatives, most of the stocks will be affected by this regime. They've been starting to climb up in their quotation. Possibly because it's a good compromise, possibly because it's an easy fix. The market was discounting a much higher rate, possibly because it was necessary. You can't see it forever on this huge pile of money. I can only imagine some headaches for the CFOs of these companies. Now, before leaving the floor to Edmund Liao, the senior partner of Dentons, Rodike, and Davidson, my question would be, if this is viable and suitable for high-tech, gigantic listed company, is it also the case for smaller entities, for SMEs? Which changes are going to face professional who works in these offshore centers? Thank you very much, Edmund. Really eager to listen more.
Thank you, Alberto. Well, good afternoon to everyone. Let me first put my slides on. Okay, very good. Well, good afternoon to everyone, and I'm very pleased to be here to talk about the global tax changes that we are anticipating. The real question, I suppose, for most of us here is, of course, how Singapore will be affected, right? Of course, Singapore is not part of the G7, but nevertheless, you know, it affects the whole world, and so therefore it will affect Singapore. But having said that, the truth of it is that there are still a lot more details to be decided. I mean, this is just an initial agreement. I mean, there are still a lot more details to be decided. So okay, let me move on to our agenda for this afternoon. So first of all, I think we need to introduce the global tax reforms with a bit of background information. So initially, you know, how did these issues arise? You know, what were the concerns that the G7 were trying to address? And it really starts with the OECD because the G20 started off with an inclusive framework on base erosion and profit shifting. It's now the second version, therefore we call it BEPS 2.0. So we'll talk a bit about the background to BEPS 2.0, and then we'll talk about the two main pillars, you know, that they were talking about. Pillar 1, dealing with the nexus and profit allocation rules, and Pillar 2 is the one dealing with the global minimum tax rate. So actually both pillars were discussed at the G7 meeting, and the two are actually related. So we will be talking about both of them this afternoon. We will then talk about the impact of the agreement reached by the G7, the impact on global tax reforms, and then finally, how does it affect Singapore, and what is Singapore likely to do, right, in reaction to this? So let's first talk about the global tax reforms and what they are all about. The G7 ministers discussed global tax reform, particularly proposed by the Biden administration in the US at the G7 summit recently. And it builds on the two-pillar approach outlined in the OECD G20 inclusive framework on base erosion and profit shifting. So what are they trying to do? Well, first, they are trying to address the tax challenges arising from the digitalization of the economy. I think that's one major aspect of it. Frankly, a number of different countries have already tried various measures, but of course, so far, all these measures were introduced unilaterally, right? They were introduced without agreement because, frankly, there's been no agreement either at the G7 or at the OECD generally. And this is really, this recent agreement is really the first step towards creating a final agreement in this area. So as I said, there are two pillars to this. First pillar deals with profit allocation and nexus. The second pillar is the one dealing with global minimum tax rate. And I think what we see from this is that the recent agreement is really an important step towards reaching an agreement. It is not the final agreement. In fact, you will see if you read the documents from this agreement, it is actually very preliminary, and there's still a long way to go. There are still a lot of issues to be decided. In fact, I think Alberta just mentioned some of these issues, right, that have not yet been decided, and I will try and elaborate on some of these issues as well. But I think people look at it, you can see the glass as half full or half empty, depending on how you want to look at it. I mean, there is no final agreement at this stage, but there is still an important step reached. And this is an important step along the way to a final agreement. So I think that is how I would characterize it. So first of all, let's go back to BEPS 2.0. What is the aim of BEPS 2.0? Well, first of all, they are trying to deal with some of the challenges arising from the globalization and digitalization of the economy. Now, what is the impact of globalization? Well, according to the OECD, $240 billion US dollars are lost annually due to profit shifting by multinational corporations. I mean, that's a figure given by the OECD. I mean, who knows how accurate that is, and who knows how that figure is calculated? Because what they say is that this is the amount lost due to profit shifting. So what is profit shifting? Profit shifting, from the perspective of the OECD, is basically the shifting of income, right, from one jurisdiction to another. So the basic idea is that multinational corporations, they have legal entities all over the world. Each legal entity is paying tax to its own country, right? So in terms of the way a multinational earns its profits, if you look at its annual report, right, it will present profits on a global basis, right? Because it presents a consolidated report. They do not look at the profits earned by each entity. But of course, in terms of tax collected, the main issue here is that each entity is paying tax to its own country. And so therefore, each entity will try to minimize tax in its own country, but in particular, the multinational will be trying to minimize tax on a global basis. And so the theory is that most multinationals will try to shift their profits from high tax countries to low tax countries. So that's the principle. Now, whether this profit sharing or profit shifting, whether it's legitimate, whether it's wrongful, I mean, that is precisely the issue that the OECD is debating. But of course, the countries that are collecting the tax, of course, will think that, well, if you collect more tax than the other country, I mean, that's great, right? So from Singapore's perspective, of course, I think the OECD would probably say that many multinationals do shift income to Singapore from other countries. Obviously, from Singapore's perspective, that's quite legitimate. I mean, there's really nothing wrong with that. But we will go into that a bit later on. The other huge area, of course, is the impact of the digital economy. And what's happened, of course, in the last maybe 5-10 years, but especially recently, is that digitalization erodes the utility of traditional definitions of a permanent establishment. Now, how does that happen? Well, the reason why it happens is because, modern business models operate through online platforms. Basically the e-commerce economy can work and can make money all over the world, right? Without having operations all over the world. So just now when I said that multinational corporations have entities all over the world, maybe that may no longer be true in the future. Traditionally, they did have entities all over the world because traditionally they would have, brick and mortar operations all over the world in order to do business all over the world. But of course, with the internet, that's no longer necessary. And so the question then is, multinational corporations can select, right? They can locate their entities and they locate their business in the countries that they want, right? And they don't need to locate businesses in every country. And of course, traditionally, multinationals have the flexibility to choose where their substantial business activities take place. And then what they do is, of course, they can shift some of their existing functions to remote locations far away from the market jurisdiction. So in other words, the main market may be in country A, but instead, the multinational chooses to locate in country B. And because their business is done through the net, therefore from country B, they are fully able to do business in country A and derive profits from country A. And of course, if you look at traditional rules of international tax, the traditional rule is that if you have an entity in country B doing business in country A, the entity in country B will only pay tax in country B. It will not pay tax in country A unless it has a permanent establishment in country A. So that's the traditional rule. That's always been the accepted rule ever since the OECD first started. But the question now is, with modern modes of business, is the international tax system fit for purpose? I think that's the real question. And the truth is, under traditional rules, these digital businesses are not subject to income tax in country A, despite having a digital presence in that country through remote digital participation. So that's really the big question. So what did the OECD do? Well, the OECD came up with some suggestions. And this came from BEPS Action 1. Okay, BEPS is an OECD project which has been going on for several years now. I mean, almost 10 years, I think. So far, there's been a lot of discussion, not much agreement. But the BEPS project came up with certain actions, right? And so one of the actions they came up with was BEPS Action 1. And so what they proposed was an expansion of PE status through the removal of the exemption of preparatory and auxiliary activities. So currently, in most international treaties, in most double tax treaties, which are based on the OECD Model Convention, right? Currently, most countries have double tax treaties which are based on the existing OECD Model Convention. And basically, that has a very narrow definition of permanent establishment, which means that a company in country B, in my example just now, has many ways of avoiding the creation of a PE in country A. And in particular, they may even set up a subsidiary in country A, which engages in preparatory or auxiliary activities. So typically, for example, marketing activities are preparatory or auxiliary because they do not conclude any sales, right? They are merely doing general marketing. And so therefore, by not concluding any sales, they can essentially avoid creating a PE in country A. So that is one of the things that, BEPS Action 1 doesn't like, right? And so they think that maybe this exemption ought to be removed, right? So that if you have marketing activities, then that should amount to a PE. Whereas currently, under the current rules, it does not. The other suggestion they had was there should be a withholding tax on digital sales. So that's another way of collecting tax. And again, I think some countries are starting to try that. But again, none of these actions have been agreed on a global basis. Of course, the other suggestions were, for example, that there should be a new kind of nexus other than PE, through a new nexus for taxation, through significant digital presence, or maybe even a virtual PE, which is a totally new concept, right? Which has never been proposed before, but this was something that was proposed. Well, as I said, none of these proposals have been adopted as internationally agreed standards, and frankly, the issue is still open today. A number of jurisdictions are taking uncoordinated and unilateral actions. For example, several countries have started a unilateral digital services tax. And because this is uncoordinated, this obviously causes a lot of issues because there are lots of damaging tax and trade disputes between different countries. And of course, there's a lot of uncertainty. So obviously, unilateral action is not very healthy. I think even those countries that have implemented unilateral action have basically said that they are doing this in the absence of global agreement. So they say that they have no choice, right? Because there's no global agreement on what needs to be done. So therefore, they need to act unilaterally. And what they have said is that when global agreement is reached, then they will withdraw their unilateral action. So that's what many of the existing countries have said. The other factor, of course, very recently in the last year or two, is the COVID-19 pandemic. Because with the COVID-19 pandemic, a lot of business that used to be done traditionally is now being done online. Now, what does that mean? Even before COVID, there was already a growing online business, right? The e-commerce sector was already growing very rapidly, even before COVID came along. And now with COVID, I mean, that has accelerated the trend of digitalization. And in addition, the other consequence of COVID, of course, is that it has created a lot of budgetary issues for a lot of countries. Because lots of countries have found that they need to spend a lot of money supporting their economies, subsidizing people, subsidizing companies, which are affected by COVID. So just as tax collections are declining under the traditional rules, the need to spend money has grown. So government support, right, during the crisis reduces public tolerance in many countries of tax planning by multinational corporations. So that's another political factor. So to some extent, I would say that the reason why the G7 has been able to reach some agreement recently is to some extent because of public pressure, and that is in turn, driven by COVID. So there are two pillars, as I mentioned. What is pillar one? Well, pillar one deals with profit allocation and nexus. And pillar one is really the pillar that deals with the digital economy, because what it's trying to do is to align taxing rights more closely with local market engagement. So in other words, as I mentioned just now, you have a company in country B doing business in country A, and it does business through the internet. So I think there is some consensus in the G7 that country A should be entitled to tax this income. So in other words, the argument is that there should be some right for country A to tax the income of company B, right? Even though there's no operation in country A, and country A should be able to tax some of the residual profit in the jurisdiction where the user or where the customer is located. So that's one view. For example, what they could do is to consider a fixed return for certain baseline marketing and distribution activities that take place physically in a market jurisdiction. As you can imagine, a lot of debate goes into how this this residual profit is calculated, in what kind of activities are taken into account, how an income can be allocated, to this kind of activity, and how this income should then be allocated between country A and country B, because obviously under the existing system, country B is the one that taxes all the income. And so if country A starts taxing the same income, then there will be double taxation. And that's one of the main issues here. So there's a proposal to eliminate double taxation through the identification of the paying entity, again, through activities, through profitability, market connection, and connection with that jurisdiction. And then, of course, there needs to be some agreement as to whether double taxation will be avoided. If country A taxes this income, then will country B give an exemption for this income so that it won't be taxed again in country B? Or will country B grant a credit for the tax paid in country A, meaning that country B will still tax it, but will give a credit for the tax in country A? So that's what some of the debate is all about. But of course, as I said just now, there's been no global agreement. So as a result, a number of countries have enacted their own digital services tax, such as France, 3% on revenues deemed generated in France by digital companies. In Spain, 3% tax on digital services developed by multinationals with users located in Spain. The UK has a 2% tax on revenue of social media platforms, search engines, and online marketplaces linked to UK user participation. So again, there are all sorts of issues as to how to define, right, all these concepts, how to calculate them, and so on. I mean, very, very complicated, very, very unclear at the moment. There's also support from some developing countries like India. So India, has enacted a 6%, what they call equalization levy on online advertisement services, and a 2% equalization levy on e-commerce sales of goods and services provided by foreign operators to Indian customers. So this is what India has done. Now, so far, most countries still haven't taken this kind of action. I mean, I've given you a few examples of countries that have actually taken action, but a lot of countries who have not done it are thinking about it. And of course, maybe one reason why they didn't do it in the end is because they know that there is discussion going on at the global level. And if agreement can be reached at the global level, then they don't need to take unilateral action. There's also a big debate, of course, as to what happens when countries enact unilateral action. So for example, will these DSTs, will these global services taxes, will they be covered by existing double tax treaties? Because existing double tax treaties are intended to avoid double taxation, right? And if they are not covered by existing double tax treaties, then double taxation will result, because the same income will then be taxed in both countries. So far, many of the countries that have enacted digital services taxes have argued that these taxes are not covered by double tax treaties. Because, of course, they have to say that because existing double tax treaties follow traditional rules and basically would not allow them to tax the income of companies in other countries if those companies do not have PEs in their own countries, right? So generally, what a lot of countries have said is that our DSTs are not covered by double tax treaties. And one of the arguments they have used is to say that these taxes are not income taxes, right? Because double tax treaties generally cover income taxes. And if these DSTs are not taxes on income, they are taxes on some other kind of revenue, then arguably they are not covered by existing double tax treaties. So that is another huge debate that is still going on. And by the way, that debate has not been resolved by the recent G7 agreement. So pillar 2 is the one that maybe has attracted a bit more media attention and that is on the global minimum tax. And what they're trying to do is to prevent profit shifting of intangibles to tax havens by multinational corporations. And what they're trying to do is they're trying to create what they call a level playing field and reduce harmful tax competition. How do they do that? Well, the aim is to ensure that all multinational corporations should pay a minimum level of tax, regardless of where the physical presence is, right? So in other words, regardless of which country they source their income from, and regardless of where their physical presence is. Now, you may ask, if such a rule is implemented and particular countries do not tax this minimum level, then what will happen? I mean, how is this agreement going to be implemented? Because don't forget, each country is sovereign, right? Each country has a right to determine its own tax rate. Some countries have no tax at all, right? Some countries have very high taxes, others have low taxes. Different countries also have different ways of calculating the taxable income, right? So the tax base is defined by each country in its own way. And again, because each country is sovereign, each country has a right to do that. So Singapore, for example, has a territorial tax system. Singapore taxes Singapore-sourced income. It does not tax global income. Singapore also does not tax capital gains. Many countries do, but Singapore does not. So the question then is, when you calculate a minimum tax, how is this minimum tax going to be implemented? What kind of tax base are you going to use in order to calculate this 15% or whatever tax rate? But essentially, the way it works is that assuming there is a system, right, that applies globally, then what will happen if a multinational is not taxed at this minimum level? Then there could be, for example, a top-up tax. So, for example, if a US multinational, has not been taxed at this global minimum rate in the various jurisdictions where their various entities operate, then possibly the source jurisdiction, in this case, possibly the US, would apply an additional tax, right, in order to reach this minimum. Or jurisdictions where there are payments made to tax haven entities may apply a withholding tax to top up, or perhaps may deny deductions for payments made to these tax haven entities. So in other words, there are various ways that this global minimum tax could be implemented. But frankly, at this point in time, none of those ways have been discussed, because so far, all that the G7 has done is to say, well, we are going to have this minimum tax rate, but as usual, as with many multilateral conventions, the devil is in the detail. But of course, there's no way they can reach agreement so quickly on all these issues. It's very, very complicated, very technical. So of course, they will say that agreement, will be reached later on, or the details will be reached later on. I mean, the best example of this type of scenario, of course, was when the EU went after Apple, right, for putting its income in Ireland. And of course, the Commission then ordered Ireland to recover 13 billion euro of unpaid taxes and interest from Apple. But of course, in the end, that decision was annulled by the European Court, right, in July last year. So this is not free from controversy. Okay, it's very, very controversial. It's very, very complicated. Now, what happened in the G7? Well, the ministers agreed to allocate new taxing rights to market jurisdictions of at least 20% of profit exceeding a 10% margin for the largest and most profitable multinationals. Now, that's very convenient because they didn't define what are the largest and most profitable multinationals. So that's a big, big question mark. I mean, given the situation with Apple, I'm sure Apple will be one of the multinationals included, but nevertheless, it's not clear, right, where this rule applies or where it doesn't apply. And of course, it's also very difficult to reach agreement on how to calculate, right, the formula, because it's 20% of profit exceeding a 10% margin. So how do you calculate the profit margin? Now, if you recall, this idea of reallocation of profits and taxing rights came from Pillar 1. Pillar 1 originally was aimed at the digital economy. But if you look at the statement from the G7 ministers, it actually doesn't mention the digital economy. So essentially, what the Biden administration did was they expanded the scope of this approach beyond the digital economy. And in fact, this statement on 20% of profit exceeding a 10% margin does not mention any particular sector. So potentially it could apply to companies in any sector of the economy, whether digital or not. So for example, just to give a strange example, if you look at a mining company in Australia that sells iron ore to China, right, which I believe is where most of the iron ore produced in Australia goes, maybe this mining company should be taxed in China, not Australia. I mean, perhaps this may not be one of the largest or most profitable multinationals. So perhaps not. But all I'm saying is that, no one knows where this rule will be applied, how it will be applied. And given that I mentioned mining and I mentioned iron ore simply because to illustrate, the point that nowadays, under this G7 statement, it's no longer restricted to digital companies. So it could potentially apply to companies selling iron ore. It could apply to companies selling oil. I mean, it could apply to virtually any sector. And of course, the other comment that has been made is that some digital companies like Amazon may not be caught by this because apparently Amazon's profit margin was only 6.3%. So only companies with a profit margin exceeding 10%, right, would be caught by this approach. So that's another big issue to debate, right? And is it appropriate, for example, to look at the profit margin of a multinational? I mean, Amazon makes lots of money, but its profit margin is not that high. And that's simply because of its business model, right? Amazon depends on high volume, not high margin. So maybe that's why its profit margin is only 6.3%. So again, that's a huge issue which has not yet been decided. Having said that, the G7 ministers did agree that assuming that global agreement is ultimately reached, then they would be willing to repeal their existing digital service taxes and other similar measures. So that's again another issue altogether. Of course, having said that, that's what the G7 said. We don't know what the rest of the world will say, right? Because obviously the rest of the world hasn't agreed to repeal the digital services taxes. India, for example, which has, I mentioned, their own tax, well, no one knows what India will say. And of course, so far, I don't think China has been consulted either. So I think there are still lots and lots of issues. I think what the G7 said was that further details will be discussed at the G20 finance ministers meeting. So I think we will need to wait for that, see what happens there. Okay, let's move on to Pillar 2, and that's the global minimum tax. The G7 ministers agreed on a 15% global minimum tax rate. So the OECD previously had proposed 12.5%. And the Biden administration, in fact, had previously proposed 21%. Okay, but I suppose maybe 15% is a compromise on that. But again, there's a big question mark as to who this will apply to. So the OECD had proposed a 750 million annual revenue, in euros as a threshold, right? And the OECD had also proposed a methodology, but again, that's yet to be agreed. What was Singapore's response? Well, Singapore's response was actually even before the G7 agreement. In this year's budget, our finance minister, Heng Swee Keat, said there are ongoing discussions to revise international tax rules under the Base Erosion and Profit Shifting, or BEPS 2.0 project. These proposals will adversely affect our corporate income tax revenues. As I mentioned in this house previously, we are actively involved in these talks. So in other words, Singapore is involved in the talks, and obviously we'll look at what happens before deciding how Singapore will react. But obviously, Singapore will respond to global trends. I mean, Singapore has never resisted global trends. It's just a question of how the rules will apply. But frankly, I don't think Singapore can really decide what to do until the detailed rules, are known. What is the impact of the global tax reforms? Well, it will require countries to impose higher taxes on companies. According to the OECD, there will be Pillar 1 rules will increase corporate tax revenues by 0.2 to 0.5%. Pillar 2 will increase global tax revenues by 1.6% to 2.8%. That's actually quite a lot, okay? Pillar 2 apparently will, according to the OECD, create additional tax revenues of 42 billion to 70 billion US dollars. Of course, the question then is, what about countries that don't need to raise tax revenue? There are countries, for example, traditionally the oil countries, right? They don't need additional tax revenue. Some of them don't have any income tax at all because the government has more than enough money just from the oil revenue. So why should they be obliged to tax at least 15%? I mean, that's obviously a big question which no one has really answered at this point. Of course, if these rules are implemented, then it will encourage the relocation of investment that is currently in low tax jurisdictions. The OECD thinks that only a small negative effect will result on global investment. They think that the proposed pillars mostly affect highly profitable multinationals whose investments are less sensitive to taxes. And it will certainly increase the importance of non-tax factors in the investment location decisions of multinational corporations. It will probably erode the tax sovereignty and increases the homogeneity of tax systems. As I mentioned just now, currently, every country has the right, because it's a sovereign nation, to decide on its own tax rates, to decide on its own tax base. Obviously, if there's going to be a minimum tax, then this minimum tax has to be calculated based on a common system and a common tax base. And there will be detailed rules on everything ranging from, the source of income, ranging from what expenses are deductible, ranging from how capital expenses will be amortized. I mean, there will be numerous issues. It will probably also reduce the ability of governments to use tax incentives to pursue specific policy objectives, right? For example, a company or a country is trying to encourage green energy or the reduction of emissions, right? Or nature conservation, for example. So a country may think, well, I will give you tax breaks, right, for companies that that undertake certain measures. Well, sorry, you can't do that anymore because the global minimum tax doesn't allow you to do that. Or a country may say, well, I will give you tax breaks if you do more charity work. Well, sorry, you can't do that anymore. I mean, the minimum tax doesn't allow that. So there are clearly some consequences, right? And of course, what will happen is that every country is still going to compete for investment. I mean, the fact that you have a global minimum tax doesn't mean that countries stop competing for investment. I mean, there is still a huge global competition for investment that is not going to stop. What does that mean? That means that countries will have to do other things to attract investment. other than giving tax incentives. Now, some of these measures could be other types of taxes, real property, real estate type taxes, maybe customs duties, different types of taxes, maybe. Countries may try to give incentives in those other types of taxes. Or maybe non-tax measures at all, right? In fact, lots of countries are already doing that. Lots of countries are subsidizing real estate costs, right? When companies invest, some countries are subsidizing labor costs. So the fact is that competition for investment is not going to stop. And so I think, frankly, one has to wonder why it is that this whole area is focusing on just one very narrow tool to attract investment: income tax concessions. Very, very narrow. Not even other types of taxes, but just income tax. Does that mean that other tools to attract investment are fair? In other words, if you think that tax competition is unfair, then why is subsidizing labor fair? Or why is subsidizing land cost fair? Whereas income tax concessions are unfair, right? So, I mean, that's a huge issue which really has never been discussed. Okay, what is the impact on Singapore's value proposition? Well, of course, Pillar 1, in terms of the creation of a tax base in the market economies, right? The reaction to the digital sector, I think potentially may reduce Singapore's tax base. Lots of digital companies do have big operations in Singapore. In fact, to be honest, many of the same multinationals who have located in Ireland, I mean, many of them also locate in Singapore as well. So to the extent that, if they have entities in Singapore selling into other Asian jurisdictions, and if these other Asian jurisdictions start taxing this income, then of course, there may be a reduction in Singapore's tax base. Of course, the truth of it is that I suspect many of these multinationals will still continue to operate in Singapore, simply because Singapore's geographical location is ideal, right, in terms of multinationals trying to set up hubs in the Asia Pacific. But of course, some of those profits from those hub operations may be reallocated to market jurisdictions. And in terms of Pillar 2, which is the minimum tax rate, of course, that may neutralize some of Singapore's tax incentives and may contribute to some profit leakage in Singapore's corporate tax revenue. Now, obviously, those multinationals that have tax incentives in Singapore currently may well be taxed at lower than 15%, right? Because Singapore's normal tax rate is 17%. If you have tax incentives, you may well be taxed at less than 15%. But of course, I think we are already seeing that Singapore is already, starting to look at other ways to incentivize investment rather than tax incentives. So in other words, I think Singapore realizes, right, and in fact has realized for several years that something like this may happen. So I think over the last few years, they've already been moving in that direction. Now, if tax rates go up, of course, then it may also impact other companies, because don't forget, this minimum tax rate is only meant to apply to large multinationals. But what about other companies? What about SMEs? If tax rates go up, then that could potentially affect all companies, including SMEs. Or perhaps, Singapore may start taxing capital gains, for example, or may start taxing foreign source income, for example. So how will SMEs be affected? So that's a big question. I think what we've already seen so far is that the government is already imposing more stringent requirements to qualify for tax incentives. I mean, the truth of it is that, 10, 20 years ago, it was probably easier to qualify for tax incentives compared to the situation today. So that's already happened. And I think this trend, could potentially continue further. As I was mentioning, only large multinationals are supposed to be affected by the minimum tax rate. A lot of companies that benefit, from Singapore's business-friendly tax system and tax incentives are SMEs. Multinationals, I think, will probably still be attracted to Singapore because of other non-tax factors other than tax incentives. But of course, I think Singapore will have to adapt, and Singapore will have to find other ways, right? Other tools to attract investment. I don't know whether, for example, Singapore will introduce different rules for small and large companies, right? Because small companies are not affected by the minimum tax rate. So I don't know whether there are ways to differentiate between small and large companies. I mean, to some extent, Singapore already has exemptions, for small companies, right? If you operate in Singapore, you'll know that your first $100,000 of income is taxed in a different way. So again, some of these measures may increase, right, to sort of differentiate between small and large companies. Of course, if you have a company that is purely domestic, whether it's in Singapore or whether somewhere else, purely domestic companies should not be subject to the minimum tax rate, right? Because some of the measures to implement the minimum tax rate, will not affect a company which is totally domestic. Maybe if you are a Singapore company which only sells to Singapore customers, then you shouldn't be affected by all these rules on digital tax. And similarly, if you are taxed in Singapore below 15%, there's no other country that is going to try and tax you, right? Because you have no nexus with any other country. I mean, you are not a Singapore subsidiary of a large US multinational, for example. And finally, I think that Singapore will lose and will gain, right? You win some, you lose some. So Singapore will gain from the exodus of companies from the offshore centers. I think that's certainly a possible outcome of this, right? So currently, multinationals who book their profits for example, in BVI or Cayman entities, may decide that they'd rather book those profits in Singapore instead, right? So I think we are seeing already, even before these global minimum tax rules have been implemented, we have already been seeing, as a result of, I guess, previous iterations of BEPS, we have already been seeing some companies, doing that. In other words, shifting their income away from BVI or Cayman or Jersey or other similar jurisdictions, and some of that income is coming to Singapore already. So finally, what is Singapore's response? Well, Finance Minister Lawrence Wong has said, we will continue to support a multilateral consensus-based solution that is anchored on sound economic principles, promotes tax certainty, and ensures a level playing field. But essentially, trust, reliability, and integrity are ultimately what makes Singapore an attractive place for substantial economic activities. And I emphasize substantial economic activities because, as you know, Singapore has always focused on substance, right? Any company that tries to qualify for Singapore's tax treaties and has applied for a certificate of residence from our authorities, they will know that, before the authorities in Singapore issue a residence certificate, they will require substance. And that's already been the case, for more than 10 years, actually. So I think overall, Singapore should do all right. Obviously, there will have to be changes to the tax system. I mean, this globally is probably the biggest change that has happened in the last 20, 30 years. So certainly there will be consequences, but nevertheless, I think Singapore will be all right. Singapore will have to look at what happens in detail, look at how these agreements are actually implemented, and again, the details, the definitions, very, very technical issues, but these are all very important in determining how exactly Singapore will react. Okay, that's essentially my presentation. But obviously, if people have questions, I'm happy to take questions for a while.
Thank you, Edmund. Thank you for your presentation. It was very complete and interesting. Yes, we actually received a couple of questions while you were presenting, actually received via chat. We can start with these two, and then let's see if people would like to add more questions in the Q&A below. Just remember to type in the Q&A so that everyone can read them. So the first question is saying, is the G7 initiative somehow related to ESG finance? In the future, some institutional investors might start to neglect companies that circumvent full tax payments.
Well, yeah. See, as I mentioned, no detail has been announced. I would expect that there should be some exceptions, right? So again, ESG businesses are interesting because obviously this is something that's good for the world, right? Clearly it's good for the world. And of course, traditionally, how do governments encourage good things? It's not just Singapore, right? Most countries encourage good deeds by giving tax incentives or by giving tax concessions, maybe extra deductions or something, right? But if countries are no longer able to do that, then obviously that is not a good result for the world, because that will mean that ESG will no longer be encouraged, which of course is a big problem. So I do suspect that when the final details come out, I think there should be some exception, I think, to deal with this. But the question is how this exception is going to be defined. I think that's the big question.
Yeah, in fact, there was actually another question was actually asking, will the implementation of a global minimum tax rate imply that the tax incentives will cease to exist?
Yeah, exactly. So again, I think they haven't gone into such detail. I mean, to be honest, just to reach this agreement alone, I think to them was already a big achievement, right? So I think there's still a long way to go. I think that's the basic answer, which is why I say this is not a final agreement. It is the first step towards an agreement, but it's still a major step.
Okay, understand, clear. And one more question is asking then, which countries will benefit more from the global minimum tax rate?
Well, it is probably intended to benefit high tax countries. So of course, I mentioned Apple just now. I mean, I think Ireland is probably not very happy about the minimum tax rate. And to some extent, I think Singapore may not be very happy either, simply because Singapore is a low tax country. Obviously, having a low tax and a favorable tax system is one of the attractions that Singapore uses to attract investment. So of course, this is not something that Singapore will like, but the truth is that I think Singapore will be able to adapt. I mean, I'm not thinking that a lot of these multinationals will suddenly shift away from Singapore, because obviously Singapore will have to find other ways, right, to be attractive, and I'm sure they will do that.
Okay, thank you. And also, since you said it's quite still not very clear, maybe they will find other ways not to, let's say, find new different kind of incentives for corporations. So we will see, I think, in the future.
Yes, that's right.
Okay, I don't see, oh yes, we have one more question. So they're asking, do you think that the global minimum tax will affect the private wealth management industry in Singapore, such as the family offices?
Yes, okay, that's a very good question. At the OECD level, there's also a lot of debate on how the financial sector should be impacted by this. To be perfectly honest, I mean, I think both Pillar 1 and Pillar 2 were not really directly aimed at the financial sector, right? And of course, if it's going to impact the financial sector, then of course, the impact will not just be on Singapore, right? And in fact, given that many of the largest financial sectors, are in the US, such as New York, are in the UK, such as London, are in Germany, Frankfurt, are in major high tax jurisdictions. I guess the question then is, how will this be impacted? I believe there is discussion going on along the lines that the financial sector should not be covered by some of these measures. But again, we haven't seen the detail. If they create an exception for the financial sector, then of course the big question mark will be how you define the financial sector. Because again, there's always, I mean, as a lawyer, I must say, we spend half our lives dealing with definitions. So, if you say the financial sector is exempted, then the next question is, what is the financial sector? Does it include banks? Does it include stockbrokers? Does it include, investment funds? Oh, by the way, the fund industry is another major area as well, right? Because currently, the fund industry, is mostly untaxed in many situations. Because the theory, in many countries is that you shouldn't be taxing the fund industry. You should be taxing the ultimate investors who invest in the funds. So that's another major area, right? And the BEPS project, I mean, has another section that deals with how investment funds, ought to be taxed. Now, many of the family offices currently being set up in Singapore set up investment funds, right? So that's a major area. I mean, I work with many of them. I mean, they set up funds in order to enjoy tax incentives. But Singapore is not the only country, right, that treats investment funds differently from large multinationals. So that's again, the devil is in the detail. I mean, nobody knows how a lot of these rules will be defined or applied.
Thank you, Edmund, for your point of view concerning this question. There's Alberto who would like to ask you something, I think.
Edmund, thank you very much for your very comprehensive presentation. Can I ask you maybe to comment why is Ireland the only offshore booking center which have been vocative and critical of these initiatives? If I do understand, most of the other countries, they were kind of not commenting or going along. And Ireland was the only one basically alluding to some critics. What is your point of view?
Well, I think Ireland wants to express its perspective because, at the end of the day, this is political, right? It's global politics. And I suppose Ireland feels that, they need to express their perspective. I mean, obviously, Ireland's tax rate is 12.5%. It's already lower than 15%. And in fact, a lot of these multinationals, I mean, of course, companies like Apple, I mean, I guess everyone knows how Apple has been doing it because it's all been publicized in the media, unfortunately. But the truth is that, Apple's effective tax rate in Ireland is much less than 12.5, right? So I think that much I think is obvious. So Ireland obviously thinks that that is the way they attract investment, and they have succeeded, right? Ireland has attracted investment from lots and lots of multinationals, especially the US tech companies. Virtually all the US tech companies are using Ireland. So I think there's a major issue there. But having said that, I mean, I do understand that following some of the BEPS measures, I think the corporate tax revenues in Ireland have actually gone up. So people who think that Ireland won't be able to collect any more tax, I mean, it's not true. Corporate tax revenues have gone up because, again, maybe multinationals have shifted, their profits from BVI or Cayman, to Ireland, and that's why I'm suspecting the same may happen with Singapore as well.
Thank you, Edmund.
Thank you very much.
Thank you, Alberto. We have actually time for a couple of more questions. The next one is asking, do you think will Singapore ever implement capital gains tax?
Well, it is a possibility. And I mean, as I said, there could be pressure on Singapore to do that if, for example, the way the minimum tax is calculated, it requires Singapore to do that. So for example, as I said, the normal tax rate in Singapore is 17%. But we all know that Singapore doesn't tax capital gains. Singapore doesn't tax offshore income. There are various favorable measures in Singapore currently, right? So therefore, if the calculation of the 15% is calculated on a tax base which includes capital gains, which includes offshore income and so on, then it's possible that Singapore may be required, right? If Singapore wants to have a minimum tax of more than 15%, then they may be required to do that. So again, all depends on how the minimum tax base is calculated. 15% on what tax base?
Okay, which is not clear. Then one last question. So how the global minimum tax affect multinational corporation already given the DEI less than 15%?
Yeah, good question. Because a lot of the multinationals who have been awarded DEI by the EDB, many of them, in fact, I would say the majority are taxed at less than 15%, right? So I think what will have to happen is EDB will have to think about how to deal with these issues. I think the first thing they will need to do is to see again how the rules are implemented, and then after that they will need to see how these issues are defined, right? But I think maybe you can get a clue from what happened a few years ago, right? When following BEPS, Singapore amended the rules of tax incentives in order to exclude IP income from the tax incentives, right? So I think a lot of the multinationals who currently have DEI or who currently have pioneer status in Singapore, a few years ago, maybe they felt or up to a few years ago, they were able to include, for example, royalty income. So for example, if the Singapore entity was receiving royalties, that kind of royalty income was included in the income that would enjoy, the tax incentives. But a few years ago, Singapore amended the rules. So they changed the law on that. So they amended the rules such that, IP income such as royalties would not be able to enjoy tax incentives. So that's the kind of thing that could happen. Just looking at what has happened in the past in Singapore in relation to BEPS, I think that is something which could potentially happen, something similar, in other words. In other words, the rules dealing with tax incentives can change. But what will then happen is the authorities will then have to discuss with existing companies that have already received tax incentives, because obviously the EDB has already made a deal with them, right? So then the authorities will have to look for other ways. If they change the rules on tax incentives in the middle of the incentive, then of course they will have to look for other ways to compensate the multinationals. So I believe that I have some clients who are in that situation, and so they negotiated different types of tools, right, or different ways that the authorities could grant them similar benefits, even though the actual rules were changed. Because the basic idea is that EDB has always said, look, if you make a deal with us, then we will keep to our side of the bargain, right? So I think they want to do that. So how do they do that? Well, they have to grant some other benefit to compensate for any change in the rules. Clear.
Thank you, Edmund. Thank you once again to Dentons Rodijk for giving us this amazing opportunity to discuss about this interesting topic. And I would like to thank again Alberto for his presence and for being with us today again. And just wanted to remind everybody to keep on following us, ICCS website and social media for our future events. Thank you once again, everybody, for joining us, and good evening.
Thank you.
Thank you.